Hello everyone, hopefully all of you are doing fine. Today we are discussing one of the very important topics of IAS-37. What is provision? So let's begin with its definition and see what exactly is the provision with a lot of examples. So a provision is actually a liability but of uncertain timing and amount. Unlike a liability you have observed from your childhood, where you have certainty with regard to amount and timing, it is different from a usual liability. Why? Because it has uncertain with timing and amount. For instance, usually when you obtain bank loan from the bank, you know what is the repayment schedule, what amount you have to pay to the bank and when, unlike in provision where there is always an uncertainty with regard to the amount you have to pay as well as with the timing of the payment. The example of provision includes the warranty. When you sell products under warranty, you are obliged under warranty contract to pay customer any warranty claims. If their products are not working well, you are liable to pay the damages for the customer. So this is a warranty contract. You are under obliged. So you are presently obliged, which means in past you sell the goods and presently you are liable. Why? Because you have provided a warranty. So it is a liability which will result in outflow of your resources. How is it uncertain with regard to amount and timing? Because you have sold product under warranty, it does not guarantee the product will return. If only the product does not working well under the warranty time, you are then liable to pay the damages, otherwise not. Likewise, you are uncertain with regard to timing when you will have to pay for the damages. Why? Because, for instance, if a product is under warranty for a 2 year, you never know when will it return back. Maybe after a month or a 2 or after a year. So you are uncertain with the timing and also with the amount. Why? Because you never know what sort of damages the product will incur, how much cost you will be bearing for the repairing. So there is uncertainty with regard to the timing and amount, which is not in the case of a usual liability where there is always a certainty with regard to amount and timing. Right? So, do we record it in our statement of financial position? The question is, do we recognize, do we record only when 3 conditions met? The number 1 condition is there is a present obligation from the past event. Remember, past event does not always result in a present obligation. Later on, with many examples, I will clear you the difference between the past event and the present obligation. Just wait and watch. Complete the video and you will understand the difference. Not always a past event will result in a present obligation, but if there is a past event which will result in a present obligation, it is one of the conditions for the recognition criteria. The second condition is there is a reliable estimate available. Why an estimate? Obviously, there is uncertainty with regard to amount. You are not sure. So obviously you have to estimate what would be the estimated cost I will be incurring in future. Right? So accordingly you will recognize. For recognize you need to record, and so for record you need an amount. So we have to estimate. Right? The third condition is the probable outflow of resources. Probable means 50% or more chances of outflow. You or expecting an outflow which is highly likely, which means you just not having an obligation, but you also expected to pay for the obligation. And in this case, you will only recognize. So if three conditions are made: one, there is a present obligation arises out of the past event; the second, there is estimate which is reliable; and the third, if the outflow is probable, which is highly likely, then you will only recognize. So let's dive into the example and see what exactly is the provision. So first thing is the past event. So what is a past event? It is the same, the goods sold under warranty. So obviously you are presently obliged. You have made a contract with the customer under warranty to pay for the damages. So this is past event. Is it resulted in a present obligation? Yes. You are legally bound under contract to pay for the damages. If you don't, he will take you to the court. So you are legally bound. That's why it is present obligation. It is currently make you liable. The day you made a contract, you are liable to pay for the damages, right? So it is a present obligation. So do you have a probable outflow? Yes. Why? Historically, whenever you sell goods under warranty, 20% of your customers will return back with the warranty claims. So you expect an outflow which is probable, which is highly likely. You will have to pay out of your pockets for sure, because in history it always happens. So this time it will be happening as well. So do we have an estimate, a reliable estimate? Yeah, maybe. Why? Because you can estimate the damages cost, because in past always you see the similar damages happening with the product and you will incurring so and so cost. So you can predict the estimated cost you will be incurring. So here you have the estimate available, which is reliable, as you will take the estimate as a result of the past events. Likewise, the outflow is probable as well. In past, you will incur the cost in future for the warranty claims. So it is also highly likely that you will be incurring cost in future as well, and there is a present obligation because you are legally bound to pay. So this is a provision and you will have to recognize a provision. Now let's see another case. Here I'm taking the very same example. The goods were sold under warranty. You are presently obliged. However, here history shows the product that you are selling is always working fine. Never ever customer return back for the warranty claim. So in this case, the outflow is unlikely, very unlikely. So here the second condition does not meet. Even though if you have an estimate, you will not recognize the provision. Why? Because the outflow is unlikely. Let's see another example. Here I am selling a driverless car. Now remember, this is a car which is newly introduced by my company. Not only just by my company, but is a new invention in the world. Never ever it has been introduced before. So I have no any history, not from my own company, not from any other entity, with regard to this newly introduced driverless car, and I have sold it under warranty. So if I have sold under warranty, I'm under contract to pay for the damages. So definitely I have a present obligation. I'm liable. Do outflow is probable? Yes, it is probable. Why? Because it is expected that customer will return back and I will have to pay for the damages because it's new, and it is highly likely that it may return back. However, I don't have an estimate. Why? Because there is no history with regard to the driverless car. What damages I will be expecting, how much cost I will be incurring. So I can't reliably estimate the cost of repairing. So in this case, I may not recognize a liability, a provision. Why? Because the third condition of having a reliable estimate